I'm co-director of the Volatility and Risk Institute here at Stern, and on behalf of Bankivan Katswaran, who is director of the Center for Global Economy and Business, I'd like to welcome you all to the talk this morning. It's a great pleasure for us to have Mary Daly, who's President and Chief Executive Officer at the Federal Reserve Bank of San Francisco, to be here to share her thoughts about the economy, monetary policy, and to take some of your questions and have a great discussion this morning. Mary Daly has been president of the San Francisco Fed since 2018. She is currently a voting member of the FOMC, and so her remarks will be very much on point this morning, and we look forward to hearing from her. Without further ado, Mary, the podium is yours. Please join me in welcoming Mary.
Thank you very much. Appreciate it. Well, good morning. It's really a pleasure to be in New York again and have the opportunity to speak with you about the economy and monetary policy. I very much appreciate the invitation, so thank you, and thank the Stern School, and I look forward to a lively discussion. Now, instead of starting with a discussion about monetary policy, I'm going to begin with a story. The story sets up well what I think is important at this moment. So last week I was walking through my neighborhood, just walking around, and a young father with a stroller, a toddler, and a dog with him called out to me, "President Daly." He wanted to ask me a question. His question was, "Are you declaring victory?" And I immediately, reflexively almost, said no, absolutely not. The FOMC will not be satisfied until inflation is fully down to 2%. We're on the job. But as it turns out, that's not what he meant at all. What he wanted to know was that we wouldn't stop with just being satisfied that inflation had touched 2%. He wanted low inflation, a healthy labor market, and a durable expansion. He wanted a chance to catch up and then a chance to advance. A chance to recoup what he saw as being lost to him from high inflation, and an opportunity to build his career, his family, and his community. Ultimately, what he said to me is, "I just want an opportunity to be better off, but I've got to get back to where I was before I can start that." Now, as a policymaker, that has always been my objective from the get-go, to deliver that foundations for that type of an economy. And now with inflation easing and the economy back on a sustainable track, that objective that we've always had can be our focus. So today I will discuss the progress we've made in bringing inflation down and the importance of looking beyond just that and looking towards something after a soft landing, aspiring for a durable expansion with sustainable price stability. Now, if you haven't been to a Fed talk, you know that before I go any farther, probably should have said it earlier, I'm going to remind you that the views I express today are my own and do not necessarily reflect those of anyone else in the Federal Reserve System. So I'd like to start with where we are right now, where the economy is today. Clearly, we are in a better place. Inflation has fallen substantially, and the labor market has returned to a more sustainable path. The risks to our goals are also now more balanced. I'd say they're in balance. And this is a significant improvement from just 2 years ago, when we were fighting inflation from very far away. Now, this figure, I rarely This figure shows inflation in the dark blue line and the unemployment rate in the lighter blue line. And you can see from the dark blue line that since March of 2022, when the FOMC began raising interest rates, inflation has declined from over 7% at its peak, a very high number, to just over 2% in the most recent readings. Inflation expectations, which aren't shown, but also reveal that people believe that inflation will come down. It confirms for us that households, businesses, and markets see the progress and believe it will continue. At the same time, and this is going to be demonstrated by the light blue line, the labor market has cooled. Most labor market indicators across the entire dashboard of labor market measures show that they're at or near their pre-pandemic values. And the unemployment rate, which is usually considered a good summary statistic of labor market tightness, is now hovering around a level judged to be sustainable over the longer run. That's that dotted blue line. And all of this means, from the labor market side, both the dashboard of measures and the unemployment rate, that the labor market is largely normalized and is no longer a major source of inflation pressures. So if you put these two things together, inflation and the labor market, it really shows the conditions have improved. And of course, as conditions improve, policy needs to adjust. Now remember that during the fight to bring inflation down, we at the FOMC had raised rates aggressively and kept monetary policy very tight, historically so. And then each month, and this is another piece that's really important, each month that inflation fell, the real rate of interest rate rose, making policy even tighter than we had it in nominal terms. So the FOMC needed to recalibrate, and we did so at the September meeting. I see this recalibration myself as right-sizing, recognizing the progress we've made in our two variables, full employment and price stability, and then loosening the policy reins just a bit, but definitely not letting them go. Even with this adjustment, this 50 basis point adjustment we made in September, policy remains restrictive, exerting additional downward pressure on inflation to ensure it reaches its 2% target. So making these adjustments, however, is crucial. It prevents the mistake of over-tightening and ensures we are supporting both of our goals. After all, monetary policy acts with a lag. We have to start early, long before we get there, to ensure we don't over-tighten. And continued progress towards our goals is not guaranteed. So we must stay vigilant and intentional. What does that look like? Well, it means continually assessing the economy and balancing both of our mandated objectives. And the reason I keep pointing out balancing both of our objectives is because this is a change from almost 2 years of study work just trying to bring inflation down and slow the economy to do that. But now both of those goals are in the frame. Elevated inflation is no longer the only thing we're worried about, and we have to be really focused on fully delivering on 2% inflation while ensuring that the labor market remains in line with full employment. And that, I would say, is how people define a soft landing, ensuring that we hit 2% and we don't tip ourselves into a downturn in the labor market while we're doing it. But that brings me to the father in my neighborhood. As he reminded us, that soft landing piece, that getting to 2% without breaking the labor market, is only part of what people want. It's only part of what they need. What households and businesses and communities really care about is a durable economy with sustained growth, a good labor market, and low inflation. High inflation chipped away. It's like a treadmill almost, or an ice pick. You know, you can use your analogy, but high inflation chipped away at real incomes and purchasing power, and it intensified the challenges of overcoming pandemic disruptions. Everyone in the country felt it, but the burden fell particularly harshly on low and moderate income families who spend a disproportionate share of their resources on shelter, food, and fuel, where price increases have been especially large. Businesses also struggled, and this is less talked about, but very, very true. Businesses, especially small and medium-sized firms, were saddled with back-to-back challenges of pandemic closures, which stopped their business sales, supply bottlenecks, which limited their inputs, labor shortages, which made it hard to hire and keep workers, and high inflation. In both for families and businesses, a durable and sustained expansion allows them to recoup their losses, rebuild incomes, and then build wealth to raise their economic well-being. And all of this, in the end, helps communities, which depend considerably, and not entirely, on households and businesses. Communities thrive when households and businesses thrive. So the question then is not should we do it, the question is it possible? Well, history tells us yes. Now, I made this chart because I wanted to see just how stark the history was. And it really is clear. If you compare the 2020 expansion, which is this gray bar, to previous expansions, you could easily say that the current one we're in is relatively young. And I've actually had the benefit of working at the Fed during the two longest expansions on record, the 128 months and the 120 months, which were the 1990s and the pre-pandemic period we just came through. During both, I remember, remarkable things occurred. And you can see this in the data as well. Businesses thrived, workers got jobs, and gains in household earnings, incomes, and wealth were widely shared. The expansion just prior to the pandemic was especially impressive. It went nearly 11 years, 10 years and 8 months to be precise, the longest in recorded US history. Again, I saw firsthand what the data tell us. Sustainable growth with low inflation delivers opportunities. The last expansion brought robust labor markets, which encouraged a broader group of workers into the labor force and into jobs. More and more Americans entered and re-entered the labor force, moving up the ability for us to produce. Wages and incomes rose and inequality fell. Even wealth gains, which are the hardest sometimes to capture, were widely shared, with lower net worth families generally seeing the largest growth in their holdings. And all of this meant better conditions for households and business across the country. No region in that period was left behind. Everyone shared. Now, we've already seen some of those same patterns play out in our current expansion, even though it's young. Labor force participation for prime age workers, which are those 25 to 54, has reached new highs. Earnings gaps between high and low wage workers have closed somewhat. And after rising initially during the pandemic, household income inequality has fallen back more recently, receding from those increases. The bottom line, no matter which expansion you look at, and I reviewed the 90s, the last one we had and the current one we're in, the message is the same. Sustained expansion helps all Americans. Now, in coming months and years, there will almost certainly be economic bumps, disturbances, and scares. And the Federal Reserve cannot prevent shocks, it cannot fully prevent those shocks or others from having an impact. But barring such events, and with the right monetary policy mix, we can help create the conditions for enduring growth. From my experience, the most important trait in a central banker is the ability to look ahead, to keep an eye on today, what's happening now, and an eye on tomorrow and where you're headed. The work to achieve a soft landing is not fully done, and we are resolute to finish the job. But that cannot be all we are after, especially at this moment. We must strive for a world where people aren't worried about inflation or the economy. I would love it if no one asked me those questions anymore, because it would be in the back of their mind. I want a world, and I think we can move towards that, where people have time to catch up and then get ahead. That, as I told the young father on the sidewalk, is my version of victory. And that's when I will consider the job truly done. Thank you very much. I look forward to your questions.
Thank you so much.
Thank
Fascinating
you.
speech, as always, especially with the sort of longer term view rather than soft landing, no landing, hard landing, where are we? You're not declaring victory, but you sound so much more optimistic than you were 6 or 9 months ago. Can you quantify how much more optimistic you are and why specifically?
Sure. So I'd still characterize myself as just cautiously optimistic. I'm never so optimistic that it clouds my judgment about how much work is left to do, and I don't think we're there yet, as we said. But what's made me more cautiously optimistic is really a whole list of things. Well, first, that chart you saw in the figure 1 I showed, I mean, we have been able to get inflation down without a major disruption in the labor market. Now, we thought that was going to happen. Many of us have done research in the system on this. Academics have done research on this, that because we were at this point where we were on the very steep part of the beverage curve, we could get vacancies to come down without disturbing the unemployment rate because it wouldn't cause layoffs. Firms would just remove vacancies. So we predicted that would happen, but you never know, and it did happen. And so we were able to get inflation down along with the supply chain and supply disruption recoveries. Inflation has come down without a big disruption in the labor market. That is giving me more optimism, more confidence. The fact that inflation has started to come down in all the categories that we look at. So we look at the whole aggregate of inflation, but we follow in, really critically housing or shelter price inflation, core services outside of housing, and goods. And when supply chain's recovering, I always thought goods would go down, but I was less certain about the core services ex housing. Without housing, core services is really the other parts of the service industry. A large fraction of those budgets are wage-based, compensation-based, and so the labor market running hot was contributing to that. So at this point, I feel much better about that. And then the other factor that's really giving me more optimism is firms and workers, businesses and workers are still in the game. If you fly in, I don't know how much you fly into your own city, but flying into New York, it is vibrant. I was here in March. It's way more vibrant than in March. Every time I come, the traffic's worse. There's more people on the street. I know that's very bad for you, but it is, as an economist, a central banker in particular, I'm like, yeah, great. There's tourists everywhere. I mean, it's fantastic, right? So I know it's hard if you live here. It's great if you're a central banker because you say people are still in the game. And what I'm hearing more and more and more from firms is that their ability to pass along price increases just is limited. And that's been helpful because, one of the best, as as everybody who studies economics knows, one of the best bridles for inflation is consumers' unwillingness to pay higher prices. Because when they stop paying higher prices, firms don't raise them any longer. So that dynamic is really important to us. So yeah, cautiously optimistic.
We've been speaking with a lot of economists and a lot of analysts of consumer credit, and they've been saying the consumer is very healthy. Actually, the recent numbers revised up the savings rate in the earlier parts of this year. Is there a sense that that sort of durable expansion that you're talking about will come with a significantly higher rate than historically? In other words, for the Federal Reserve, the neutral rate, where it's not restrictive or accommodative, is going to be in a range maybe that's significantly higher or not so much?
It's really hard to say at this point. And I think, there's obviously, people want to know where will the rate settle. That's a common question we get asked. But the truth is we're a long way from where it's likely to settle. So the decisions that are really in front of us are ones about how quickly to adjust towards that level. But it's quite possible that, we will have a neutral rate of interest that's a little higher than the interest rate that we came in with. So if you thought the neutral rate of interest was 0.5 coming in, which many did, and so that would be the real rate, that would mean the nominal rate's 2.5. Then, if you say now it's probably 3, I think that's a completely reasonable way to believe. What I don't know is if it's higher than that or if it'll get back down to 0.5. And I guess I keep reiterating this, but I do think it's true. Largely, deciding what the benchmark is gives you some help, but it doesn't tell you what to do because you're really marching down towards that in a way that is supporting the dual mandate goals of getting to price stability and supporting full employment. And if we get a lot more traction on the rate declines that we think we're going to get, that means we're closer to the natural rate. If we get less, that means we're farther from the natural rate, and we'll just learn experientially. So humility is a very good characteristic to have when you're talking about the real rate of interest.
One thing you said to me probably about a year ago, and I thought it was such an insightful point, was that the data always gets messy at turning points and always gets contradictory. The data hasn't gotten much clearer. So I'm wondering whether turning points can last a year or 2 years, what that means if there still is that lack of clarity and contradiction in the data.
Sure. I mean, I think I use the term inflection points because turning points makes people afraid, honestly. They think we're turning from, starkly from one type of economy to another. But an inflection point is just about the slope of the line. And so if we're growing really rapidly and we're just going to slow and inflation's going to come down, I think that is a nice inflection point, but that can last for a while. It's not something that I expect it to go away. I don't really expect the data to become a lot clearer. And by clearer, I mean less sometimes contradictory, definitely volatile. Data always get revised. They're revised all the time, but revisions go up in these kind of inflection points or turning points or changes in the economy. So what's really important is not to look at one data point and become data reactive. I'm trying to get us all out of this idea that we should be data reactive, because being highly reactive to data that get revised is going to be unsettling, but it's also a recipe for bad policy making. So I really look at a preponderance of evidence. Maybe this is where my microeconomics training comes in handy. So in micro, you really never know the truth by running a regression, so you look for the preponderance of evidence. And the preponderance of evidence on the labor market and inflation is that they're both coming back down to normal, to inflation to price stability, and the labor market to a sustainable pace of growth. So that's how I think about it. And yes, the data are going to continue to be messy, so don't bet on tomorrow everything getting clear. Well, next year, maybe.
Well, that's actually one thing that people are saying going into the next Fed meeting, that it's going to be very difficult, given the hurricanes and what's been happening, that the jobs report's going to be incredibly messy and an unreliable data point to be particularly reactive to. Does it sort of have less weight this time around because of that?
So I'm going to offer this from my vantage point, and maybe it'll be surprising. So the labor market report never gets the central focus of our attention, or my attention, right? It is a piece of information, as all the other pieces of information are. And so when they're noisier, then you say, okay, they're noisier, they still give us some information, but in an inflection point or in a policy, we're changing the policy stance, you can't rely on backward-looking data. And all these data are coming in, are looking to what happened over the last several months. Now, that's a helpful input in forecast, but our job is to look forward. I said the most important trait of a central banker is to look ahead. If you're looking ahead and you're only looking at that backward information, noisy or not, you're going to be behind. So you have to put that in as an input, noisy or not, all the other preponderance of information you're getting, and then you're asking. That's why we have, the benefit of having the 12 reserve banks is we're out constantly in our communities asking businesses of all sizes, global Fortune 500 companies down to small coffee shops around our neighborhoods. We're asking those businesses, we're asking worker groups, unions, community leaders, what are you seeing and what are you doing, importantly? And then we can put all that together and make a decision about where the economy is headed. So right now, more than a labor market report that has a variety of disruptions, all of which you've named, in it, I'll be asking my firms, as we call around or do our roundtables, are you slowing hiring? Are you managing your headcount through attrition like you have been? How close are your layoff plans to your desk? Are they still in the cabinet, or did you dust them off and they're nearby? Are they on your desk? Are they in your boardroom? Those are the kind of questions, because you need to know when they're sequencing that. That tells you what they're thinking about.
One thing that I was thinking about when I was listening to your speech was you're talking about how right now the rate is too restrictive. It would be too restrictive if you didn't lower it.
It would be, yes.
Because of how much inflation has come down, and just the natural rate on a real basis would be much more restrictive. And yet when you take a look at financial conditions, it's up in a way in certain places. And a number of people, one commentator today said to me that basically the Fed put is back in a massive way, more than even in 2010, because there's room to drop rates, and that's going to support the sort of risk drive that you've seen across the board. How do you view that as sort of a consequence of policy that doesn't cohere maybe with the father on your block and his reality?
So I think ultimately, and this is always complicated to explain, but it is true. So I'm going to give it another try. Is that financial conditions are a an index of a variety of indicators. The stock market has been very, very strong. And if you narrow it down even further, the Magnificent Seven's been very, very strong. And then I'll bump into a manufacturing firm and they'll say, we're in a recession. So this is always a mix, and unpacking, not just looking at aggregates, unpacking is important. The other thing that's important is the interest rates that affect the economy. Not everybody is using equities to fund themselves. A lot of businesses, I'd say most businesses in the country, are using, borrowing. Either they borrow from credit cards, they borrow from their house, their equity in their home, or they get bank loans. And those things are very affected by the interest rate. So it's really that real side of the economy that's responding to that. So I'm looking at our policy stance, and then I'm looking at the full range of rates, not just how the stock market's reacting. So, financial conditions are very good, and indices are very good things to follow. But when they're looking like they're different than how the real side is going, then I always unpack those financial conditions. And if they're narrowly located, then you can see those sectors are going to be fine, but everybody else around them is part of our mandate too.
Yeah, and I wish we had more time, because there's also the housing market and questions around that. The sort of was stagnation that really happened because people were locked into low mortgages and didn't want to leave.
That's changing, by the way.
Is that?
Oh my gosh, I'll just give you one anecdote from where I live in the Bay Area. So in my neighborhood, which is not San Francisco but Oakland, before the interest rate cut, the 50 basis point cut, there were like 2 signs outside on Saturday and Sunday for homes for sale. And when I went around the neighborhood the other day, there were 52 signs. I stopped counting at 52 because it got exhausting. There were probably more, but I was going to lose count. I was busy, should be driving, that kind of thing. But I was counting, and it was just a massive change. And so it tells me that people are ready to sell their homes, that they just were waiting for the direction of change on interest rates to be down and not potentially up. And then they can get into a variable rate and they can move themselves down, and they are ready to go. So I hope that unlocks some supply. But ultimately, in our nation, we have a supply and demand imbalance that will not be solved by unlocking lockups alone.
So just, and I know I'm out of time, but I want to ask this question. Am I out of time? I've got 2 minutes. Fantastic.
Okay. I didn't know, but
okay,
I know.
I'm like,
it seems like we just got here.
I know, exactly. That's how I feel. So I wanted to ask you, because I worry about the deficit. Sorry, I'm one of these people. I watch the auctions. I look at some of the extrapolations of where things are going, and I wonder how much control, in some ways, the Fed has over borrowing costs in the long end, which is typically where a lot of these mortgage rates get pegged. And I just wonder how you even consider that as a Fed official.
So this is how I think about it. We have our mandated goals that Congress gave us: full employment, price stability. In that, we're just economy takers, right? We take the economy we're given, whatever the pressures are, and then we work to make sure with the interest rate that inflation comes back to 2 and the labor market remains near full employment, near or at full employment. The mechanism, our monetary mechanism, how it works, is always being challenged in some capacity, right? There's always, for the whole time we were lowering rates, there was a whole conversation about whether the transmission mechanism was broken. And we would say, no, well, there's just longer lags. There's some long lags. Financial conditions adjust immediately, but it takes a while to get that through the economy. So I hold the belief that we have the power in our tool to do the job that we've been given, and that we will continue to use that tool to do that job. I haven't seen any evidence that just because there's these either theoretical disruptions or even periods where things look a little bit disrupted, that doesn't play out in the longer term. Ultimately, because we have the interest rate, we have the way to ease the economy and support it and tighten it to slow it.
Is it frustrating for you ever, though, that you have to respond to policies that may or may not be working in tandem with what you're looking for?
I have a rule, I will share it, that I know what the job is when I take it, and then I don't get frustrated when it delivers what I knew. I get busy.
All right, well, I could keep going, but I know that I'm out of time, so I will cede the floor.
Thank you.
Thank you so much.
I
really appreciate it.
Who's next? Thank you.
Thank you, Lisa. Now we're going to have an opportunity for people in the audience to ask questions. And I'm sure that they have lots to ask. But before we get started on that,
Oh,
Mary,
first you. Okay, I'm ready.
I have a couple of my
Okay.
own, if that's okay.
Absolutely.
So I love the title of your talk. You know, it's only the beginning, and that implies that there's a longer-term perspective that you want us to think about, not just for monetary policy, but in general. And I think that's so appropriate. So in that regard, you know, now that the Fed has 5 years have passed since the last review of policy, and we're approaching the time when the Federal Reserve is going to think again about its longer-term strategy. How can we think about a longer-term strategy that really aligns with the kind of outlook that you're talking about? And what does that mean in terms of making any changes from, for example, flexible average inflation targeting, thinking more about, you said twice that it's really important to look ahead as a central banker. Couldn't agree more with that. How do you think about that in terms of the strategy review that's upcoming?
Well, let me first start by saying that, you know, I'm going to let the chair come out and talk about publicly, be the first person to talk about publicly what the dimensions of the framework review will be. I am a very big supporter of every 5 years reviewing the framework. I mean, I think that's really appropriate. One of the things that I've learned from our previous framework review is that when you set a review to review your framework, there's a bit more emphasis on the framework being the playbook than I had anticipated. So I thought, you know, it's a framework, it's not a playbook. So the difference in a framework and a playbook is a framework is, here's the dimensions we're looking at. It's only a page or two, you know, so it's not a long document. And then the playbook would be, how do you deal with things on a daily basis? And for instance, the last framework review we did, we wrote the results of that. I didn't feel at all constrained by the framework when we faced the period of high inflation. It wasn't like the framework was constraining me personally from adjusting policy in a way that I thought was appropriate, or voting for adjusting policy in a way I thought was appropriate for this. So I want us all to think about the framework just as some things that we're thinking about that aid us in execution of policy and also the communication of policy. And that's where I'm at. So where would I like us, what are some topics I'd like us to take on in the framework or not? Let me put it that way, is that okay?
Yeah.
I think there's a real question that we have to ask ourselves, and we were talking about this earlier in a faculty meeting. I think there's a real question we have to ask ourselves of what's the future we're facing in terms of where the real rate of interest is, whether we'll be fighting our inflation target from above or below our target, right? Will we be trying to push up inflation to 2% like we did for a decade preceding the pandemic? Or will we be back to most of our history, which is we're trying to pull inflation down to our 2% goal? That will be influenced by global inflation dynamics, not just our own. So those are something I care a lot about. I care about, you know, is this neutral rate of interest a good benchmark, a reasonable thing to think about at all? How do we think about it? How do we communicate about that? Because as you know, as Lisa asked me just a moment ago, you know, we came out of a period of low interest rates, and now interest rates are much, much higher, and people want to know, what is the right settling level between 0 and today? And those are things that we have to get better at understanding, and I think more study on those is necessary. The other thing, though, and this is more of a tactical or practical thing, application, is that, you know, we have our balance sheet tools. So we have 3 tools, really. The interest rate, that's our most reliable and historically studied tool. The second is forward guidance in my pecking order, forward guidance, which does a lot of work for us. You saw that even in July. We announced that the goals were more balanced and mortgage interest rates fell. It was just immediate. So the third is our balance sheet. And one of the challenges, and this is me personally speaking, I don't know if any of my colleagues share this, but I personally felt like we were too tied up between balance sheet policy and being able to raise the interest rate. So in November, if you remember November of 2021, we signaled that we were going to start tapering our purchases faster, but ultimately you might have wanted to start to raise rates earlier than in March. Now, a lot of that was done just through communication, but there was a sense where we couldn't do that as long as we were tapering purchases. But the tapering purchases was really for market functioning, so we didn't destroy or dislocate. And so I think just having really good academic research and Fed research think hard about whether we need to link those two together always, or if communication can solve that problem to make sure, I like to think of it, I do think of it this way. The interest rate adjustment's like a speedboat, and the balance sheet's like a tanker ship. And the question is, do you want your main policy tool to wait on the tanker ship to turn in order for it to turn? And I think that's something we do have to take up in the framework review or not. So it's like a call to all academic researchers who can help us with this, because I do think that's something that we need to really interrogate.
Great. Well, I want to get to balance sheet in just a sec, but speaking of communication, policy decisions have been virtually unanimous until recently when Governor Bowman dissented. So how can you help us understand the degree of unanimity that we've had in policy discussions and where we're going? Is that something to do with the turning point? Is there some other factor involved?
Yeah, that's a great question. And actually, a researcher at the San Francisco Fed, working I think with the Kansas City Fed, did a paper on this. And I can't remember where it is in the publication line or if we've released it, but one of my team will know and send it to you if it's been released. But the basic question was just that. And what he found, or what they found, is that when the forecasts for the economy are all fairly similar, and the direction of change of policy is only unidimensional, there tends to be a lot of unanimity. And you get, so let's take the pandemic. There was only one direction of travel for the rate, and it was down. And it was hard, I don't think it was really hard we had one dissent, if I remember, Loretta Mester dissented whether we were going to make the early adjustment to zero or whether she wanted to go in steps. So that was the only dissent, and then eventually we all went to zero, and it was fine. So that was unanimous because bad things are happening and there's only one direction. Then when inflation starts to rise rapidly, there's only one direction of travel for the central bank, and that's up. And once there was a clarity that we could raise interest rates at a pretty rapid clip without dislocating markets and families and households and businesses, then we just went up fast. And I think that was why we have unanimity. This next turn is different. It's a place where reasonable people can disagree on the tactics, even if they agree on the strategy. But when we communicate our rate changes, it's all on tactics. It's not on strategy. If you think about the strategy, it's another reason I think looking ahead helps, because it gets us out of the day-to-day tactics and into the longer-term strategy. But we've been in a bunker, so to speak, fighting on high inflation. And so now coming out of that, it's time to return to strategy. And when we're thinking about something that you can get to one way or another way, and it's a reasonable person could see themselves on either side, you'll get more dissents. I think that's a healthy component of our discussion. The final thing I'll say on this is just because you see no dissents on a vote doesn't mean there were no disagreeing discussions, right? That people disagree all the time, and that's a good thing. And then what happens is you have to decide, do you think your disagreement with the direction is so significant that it's worthy of a dissent? But there's many places, and I've been in many of these places, where you're in the gray area between, if I was the boss, I would do this way, but that's a reasonable set of arguments, and I see that the difference in what I'm suggesting and what others seem to want and see as the better way as de minimis. And so I'm not going to dissent over it. So dissent is not the only indicator of the disagreement and debate that you hope we have at a central bank. And you should expect more dissents in times like this, where we're at an inflection point and reasonable people could reach different answers about where to go.
So one of the ingredients in this long-term vision for where we want to go could be the health of the financial system and financial stability. And a resilient financial system is probably going to help you. It's going to help the economy, and I think that's something on which we certainly agree. Now, it's been 18 months since we saw banking turmoil. In 2023. And some critics would say that You know, we really haven't addressed interest rate risk or liquidity risk in the banking system adequately. We haven't had stress tests that include testing for those risks. Many banks are not subject to liquidity regulations. Some would argue that the Fed has lost credibility when it comes to bank supervision, and you know that needs to be addressed. Some would argue that we need higher capital requirements as a result. So how do you respond to that? And more generally, what could have been done differently to achieve a better outcome? And what do we need to think about going forward for financial stability and a safe and sound banking system?
Sure, that's a big question. Let me unpack it into certain points. But the first thing I have to say, because I don't think everybody in this room will have full clarity on the Fed's complicated system of governance, but Federal Reserve banks, which I lead, San Francisco, have no role in regulatory policy. So the Federal Reserve presidents have no role in regulatory policy and no role in supervisory policy or the framework, or even in the day-to-day supervisory guidance. That's not our job. That's run out of the Board of Governors. And then teams who work on direct supervision, they sit in the banks and they work for the San Francisco Fed, but they report on their supervisory activities, they report to the Board of Governors. So when I'm speaking on these issues, I'm not speaking from a position of someone who has decisional authority on these issues. But I will say that, you know, just now I'm going to step back, and from my experience as a policymaker and an economist, you know, one of the things that I was struck by, and I think you would all appreciate this, is that there is a getting used to it moment that has to be that occurs when people have been living in a low interest rate environment for a long time, and now they're suddenly in a higher and rising interest rate environment. And banks are not immune from that, right? That banks had interest rate risk, and banks are, I mean, we have a fractional banking system, so banks are meant to take some risks, right? They're maturity transformers. That's what they do. And so there's some risk in that. And they have, another thing I like to remind people of is we have over 4,000 banks in the United States, and only 3 failed. And the reason only 3 failed is because by and large, most banks are actually thinking carefully about their interest rate risk and other things. But this is something we need to do better, and I think something in the back of my mind, well now it's in the front of my mind, is that when you're transitioning from a low interest rate environment to a pretty dramatic shift to a higher interest rate environment, more has to be done to ensure everybody's coming along with that quickly. And I think that's part one. The other thing that comes to me from I sat right there in the area where Silicon Valley Bank failed, is that bank runs are now possible in a very short period of time. And that changes how we have to think about liquidity provisioning. And so that's an issue we have to take up. So on the bank side, absolutely have to be more focused on interest rate risk, especially at these transition points, right? And so thinking about how to manage that, the Fed and other regulators, so it's the FDIC, the OCC, and the Federal Reserve that regulate and supervise, have to think about those transition dynamics and generally interest rate risk. And then the final thing that I'll say, because I don't want to take all the time on this, but I do think we have to really understand what it means to have a bank run today when people can move their money so easily and so costlessly that you have a social media scare, which ends up translating into something larger. Even worse than that, perhaps, or even more tractable than the social media scare. Those seem like you can't predict them. But even more tractable is that if your organization, whether you're a business or a bank, you know, a non-financial business or a bank, if your people all know each other, then that amplifies your run risk, right? So if everybody's part of a single network, then we used to think that monolining meant you were all built on construction loans or commercial real estate or residential real estate. But now I think we also have to look at these network effects. And if you're in a single network, you might be more vulnerable.
Okay, with that, I think it's time for some audience questions. Please raise your hand. I will call on you, and please state your name and your affiliation. And then no speeches, just questions. All right, so right here in the front row.
Thanks, Michael Weinberg, NYU alumnus. Michael Weinberg, NYU alumnus and adjunct professor at Columbia Business School. I have a lot of questions, but I'll just make a quick one. Why doesn't the Fed take the balance sheet down more aggressively so that it has firepower for the next crisis?
So first, I'm not sure that the firepower argument is it really material. I mean, there is a sense where if you normalize it, you could raise it back up, but we have the ability to raise it, so even if it's large. So the second thing, though, and the more important point is the one you asked, which is why don't we take it down more aggressively? So we were taking it down more aggressively, much more aggressively, and certainly still more aggressively than the last tapering of the balance sheet, last normalization. But as you get closer to the place where you think you might run into the ample reserves level, then I definitely wanted to avoid running into that kink. We did that in September of 2019. That takes a lot of reversal of things and trying to make sure that doesn't, you don't want to cause a market dislocation. So we were running down the balance sheet very aggressively, slowed the pace of runoff recently to avoid getting there so quickly it was hard to reverse. Now, with all the monitoring that the New York Fed does, the markets desk does, I feel much more comfortable that we will be able to get to that ample reserves level without running into that kink as we did in September of 2019.
Other questions? Let's see. Way in the back.
Hi, President Daly. My name is Amanda Wilcox. I'm from UBS. And since the September 50 basis point rate cut, it seems like your colleagues have been using terminology that implies a gradual pace of cuts. So I was wondering if you could give some color on what you might be looking for in the inflation and labor data that might push you towards a faster pace or alternatively a quarterly or slower pace. Thank you so much.
Sure, absolutely. And nice to see you.
Nice to see you.
So, you know, this idea that we do things gradually, I actually gave a speech about this last year in November because it was Bernanke who first sort of introduced this idea to me anyway of gradualism. It was in 2003, and he actually gave a speech up in Seattle at in an event that the San Francisco Fed hosted. I was a rookie economist at the time, but I remember this speech clearly because his point was, if you know exactly where you're going to go, and you need to get there, you just go. He called that the cold turkey approach. I would say what we did with aggressive rate hikes was cold turkey. Then, on every other occasion, when you're less certain about where your destination will be, what our star is, et cetera, and how quickly you need to get there, then you take a more gradual approach to interest rate changes, whether they're up or down, because you don't want to go in cold turkey only to find out that you need to go back. So that was his point. And so the implication, I think, for the Fed was that we spend most of our time in an uncertainty space, right? Most of our time isn't in that space which would call for cold turkey. So I think it naturally implies some of the language you've been hearing about gradual pace of cuts, which doesn't mean as much as you might think. It simply means we're in this uncertain space and we'll adjust as we know, as we have more clarity. So when your second part of your question, though, is quite right. It's the way I think about it is, just for saving time, I will say this, that if you look at the SEP, the Summary of Economic Projections that we released in the September meeting, the medians were for 2 additional rate cuts in November and December, and that was aligned, in my judgment, with the idea that inflation would continue to come down. And did I say 2 or 3? I meant 1 or 2. 1 or 2 rate cuts. I can't remember what he said, but 1 or 2 rate cuts for the rest of the year. And that would be aligned with inflation continuing to gradually fall and the labor market staying at this largely sustainable pace. And if that happens, then I think 1 or 2 this year would be a reasonable thing that we would need to do. If, however, inflation stays stickier or shows little signs of coming down, or the labor market doesn't look like it's really settling at that sustainable pace, then you could do fewer. And if the labor market falters a little bit more than it hasn't been faltering at all, you just look at the last jobs market report, if it starts to falter or inflation just starts to come down more rapidly than we projected, you could do a faster pace of cuts. So at this point, it's clear the direction of change is down, and then the question is, what's the pace? In context, I would want to say that that 50 basis point, at least from my perspective, the 50 basis point adjustment that we made got some attention because it's like, is that the new normal? And it's, to my mind, that was just right sizing. We were really in need of, we had been patient to wait till the inflation data really made it clear that we could be confident it was on a sustainable path to 2%. And it was, I really wanted to be clear that the labor market was settling at a more sustainable pace. And then 50 basis points sort of right-sized the policy so that it was in line with where the economy is today. And all future adjustments, to my mind, will be ones that look at the data. It's a good time to say data dependent, but that doesn't mean data reactive, and it doesn't mean looking backwards. It means using the data to look forward.
Great, and not data point dependent.
Not
either.
data point. Finally, I use that all the time, but finally
There
my
you go.
team said nobody's listening.
Just thought
So
we'd throw that
finally
in.
you listened. Excellent.
Over on this side.
Hi, President Daly. I'm Dov Ziegler. I'm the chair of an alumni association called the Money Marketeers. Thank you very much for being here today.
Oh, the money marketeers,
Yeah.
yes. It's nice to see you.
A quick question. You spoke about the longest expansion on record. You compared it to the current one. What are some of the steps that you think would be most conducive to extending this expansion to be similar to others? Does it have anything to do with U-Star, another thing that I noticed in your presentation, not about the rate of change of the unemployment rate, but the level of the unemployment rate? Interesting to hear your thoughts on those points. Thank you.
Yeah, absolutely. Thanks for the question. So I think it does have a lot to do with what we do. And one of the reasons I brought it up in this speech is because as we're thinking about the trade-offs that we're facing today, you know, I really think it's important for all of us, and I don't mean just the Fed, I mean everybody to not just focus on getting from 2.6 to 2% on inflation or getting, you know, eking out the last piece of job growth so that's right on the, you know, estimated payroll growth number, but to really think about what are we trying to achieve. And I would like to see us continue to put that longer view in place. And so remember back in the previous expansion, you know, we cut interest rates twice in 2019. And I'm not saying we should cut rates like that. The analogy goes deeper. So we cut rates twice in 2019. That was against headwinds to growth that would, you know, perhaps push inflation lower. And if you remember, though, the labor market was quite strong. And there were calls on the other side to be raising the interest rate because the labor market was strong and we should absolutely keep that thing tied down so that we didn't get a pickup in inflation. Inflation was still at 1.8. So how do I think about that? One of the big lessons is that we need to really focus on making sure that the labor market continues to be sustainable. If it's a little bit higher than what these estimates of payroll job growth tell us it should be, then I don't worry about that as much as long as inflation is coming down. That's why I have that sentence in the remarks I gave that, you know, right now there's no sign that the labor market is still a major source of inflationary pressure. For many, many wage indicators, they've settled back down to inflation plus productivity growth. And that's with productivity growth at average, not even at some of the high rates we saw last year. So I think the conditions are really the mindset, making sure that we don't get overly concerned about labor market strength as long as we see inflation coming down. If, however, labor market strength is correlated with inflation staying up, then we have to look for that potential causality, and that's a different equation. But in 2019, I was reminded of this morning, and you can look at all the data and see this, the labor market was going strong in 2018 and 2019, and leaving it where it was and even supporting continued growth was, I think, a strength of that policy stance in that period, because it said we're not going to cut off labor market strength on the fear of inflation. We're only going to slow the economy when we see actual inflation coming up. And before you see actual inflation, you'll see firms telling you that they can raise prices. And right now, we're not seeing that.
Other questions? Right here.
My name is George alumni, former banker. Thank you very much for your eloquent explanation how you frame monetary policy, how you approach it, etc. I would be interested to see how do you incorporate in your decision making the other two big dimensions, I think, that determine the state of the U.S. economy, which is fiscal deficits and external deficits, and how these are fluctuating. Actually, the current deficits are a permanent feature, more or less, but fiscal is a fairly new development. And how do you incorporate that in your decision-making process?
Sure. So just to make sure everybody in the room is thinking about this the same way, so my answer is clear, is that the Fed is independent, so we have no role to play in the fiscal decisions, and we do not comment on the fiscal policies, and so we certainly don't, imagine what the scenarios could be under different global or domestic administrations, and then think about what we would do. But we do actually understand the factors that are influencing growth and spending and inflation. And so we would do that with the normal equation you learned, C plus I plus G, right? Minus exports, imports. So you basically have a government sector, and you can have a fiscal stimulus or you can have a fiscal drag. And when we put that in there, we are thinking about is fiscal kicking up the economy, and then we have another energy input to growth, or is it a drag on growth? And so that's how we do it in the growth model part of our work. On the interest rate part of our work, I mean, the deficits, some people, some academics, some researchers at the Fed think that deficits push up our star. Some don't. These are all really open debates. I think it just tells you the limits of our knowledge of our star, really. But we are ultimately, the Fed is a taker of the economic conditions, and when we see plans and other things that materialize, we can put them in our forecast for what will be the growth rate of the U.S. economy, where's the long-term interest rate going to go, et cetera. But more than that, we don't take. Ultimately, and this is the hard part about central banking, but a good part about how the original founders of the Fed set it up, we just take the economy we have and do the work that was given to us by Congress, which is low inflation, low and stable prices, which we determine as 2% inflation, and full employment. So if the economy is growing faster than is sustainable, we pull that growth back to deliver low inflation. And that doesn't matter where that spending is coming from, the government sector or the private sector. And I think that's the benefit of our independent central bank, is it's moving through administrations and even through global changes. But definitely it becomes part of our forecasting exercise once it materializes. Thank you for the question.
We have time for two more. Over here on the side.
Hi, my name is Nenna. I'm an NYU PhD candidate. Information systems, not economics. So
I was about to say, yay!
Not economics, information systems.
Okay, well,
so
that's good too.
Keep that in mind.
Nothing wrong with that.
So I do agree that economic expansion helps all Americans. However, the help is disproportionate. So does the Fed assess and capture the disproportionate impacts of the growth when it comes to economic factors? Because the figures you shared with us, I assume, are aggregate, right?
They are, yes.
And then how do those results, the disproportionate impact, compare to the aggregate results that you see?
Sure, absolutely. So the answer to your question is yes. We look at all the dimensions of the economy. And ultimately, our tools, so we have two goals given to us by Congress: full employment and price stability, and one tool, really. I mean, we use two different mechanisms or three different mechanisms to get there, but it's really one tool, which is the interest rate. And that's already a tough battle to solve two problems, or two goals, meet two goals with one tool. And we really can't, our tools are not well equipped to solve equity issues or gaps issues. But one of the things that I've uncovered in my own research is that a long and durable expansion actually is associated with closing gaps. So it is true that in any time you pick, any cross-section in time, you will find that the impacts of a particular time period are disproportionately distributed across the population. But as you get into late cycle, which I would argue we're not, as you get into late cycle, what you see is those gaps that have been historically present, whether it's between gender, racial groups, less or more educated, different locations, rural, urban, they start to close over time. They don't get closed, but we made some of the most significant gains in closing gaps in the pre-pandemic expansion. And the duration of the expansion, in addition to the tightness of the labor markets, was a contributing factor. So we look at that absolutely. Another reason the Fed looks at this is because you can get information about how the economy is doing earlier than the aggregates might tell you by seeing how different groups fare. And so some groups are, less skilled workers will tell you, lower skilled workers will tell you a little bit more about how the low wage or service industry is doing or manufacturing is doing. And what that often tells you is those are bellwethers for how the economy will do, right? So, and we can look at the same thing by region. Las Vegas is a very good bellwether for where consumer spending's going. If they stop spending in Vegas, it's coming elsewhere, right? I guess we're holdouts, right, for Vegas. Then coffee starts getting cut back. But those are the other ways we look. The final one, and I'll give you a positive story. For right after the pandemic, you might have remembered this. Two groups were said to never come back to the labor force: working moms and young people. Young people were going to go drifting off and find themselves in other countries and never come to work again. That seems misstated. I was never a supporter of that, by the way. But working moms were, because there was a lot of disruptions with the pandemic, with homeschooling and things, and now women have overachieved in terms of coming back, women with children, and young people are back in full, training and going back to work. So I think the idea that just because you see something in a moment in time, it's always going to persist, that's another thing that we can offset. But we had to study that because we wanted to know if we were going to get those members of the labor force back. And our projection was yes. Luckily, it turned out that way. But that's another reason we look at these groups. But thank you for the question.
Thank you.
One more, right here in the front.
Hi, thanks so much for coming over. My name's Kristen. I'm a student reporter for Prediction News. With the hurricane and the strike and upcoming presidential election, the data coming in for October is going to be filled with noise. So do you see a possibility of increased amount of dissent or disagreement among the member for the next federal meeting? Thank you.
So, Lisa asked this a different but similar question on when you get noisy data, what does that do? And I don't think that if there's disagreement among us, and this is going back to Dick's question, may I call you Dick? I should call you something, Professor,
Dick is
et
fine.
cetera. Okay, fine. People can call me Marriott too, so it's easier. It's easier to chat among with that. But I don't think that the disagreement is related to noisy data, published data. I really think the disagreement is related to the fact that we're still in an inflection point of the economy, and we want to get this right, and we want to make sure that we're resolutely bringing inflation to 2% and supporting the labor market, and I'm arguing looking ahead to see how we support it for a durable expansion. People are going to put different weights on those things. They're going to see the same facts with the idea of what they mean for the projection. And ultimately, what you see is as the data come in, FOMC participants find their way frequently to the same answer. But it's when the data are not in and the uncertainty bands are wide that you get this more disagreement or discussion about different directions. So I guess to close out, I don't think it's the data noise and the published data, because we have a lot of other sources of information that causes the disagreement right now, as much as, this is my judgment alone, as much as it's a hard time. You want to figure it out. Everybody wants earnestly the same thing, to get this right and to do it in a way that creates a durable expansion. And that's a tough problem, and reasonable people are going to disagree with exactly how to get there. But as you see from the SEP, everybody's direction of change is the same.
So President Daly, Mary, has told us that she will kindly stick around for a few minutes after
Absolutely.
the official presentation is over.
Yes?
Please join me in thanking her for being
Thank you.
here.
Thank you.